All right, hello again, everybody. This is Mike Rixey. I am the lead options instructor for NetPicks. And let me get my camera set up here so you can see me for a moment. And this is our weekly recap video. I wanted to jump on, talk about some of our options trades from the last few weeks. We have recapped some of those trades here in these live sessions in Facebook and YouTube. So I wanted to give you an update, take a look at where those trades stand, how we plan on managing those trades, and then also throw another trade opportunity at you here, potentially going into next week. We'll talk about why next week is so important here in just a moment. But we continue to see a very interesting market, very unusual volatility. We don't typically see volatility stay around this long at this elevated of a level. We are now going on almost a month with volatility at an upper extreme. And I definitely think that provides an interesting environment for us here in the next month or so, because we're going into earnings season. We have a lot of the individual stocks on our list that are going to be releasing their quarterly earnings. A lot of the big tech names, the financial names had earnings this week. JP Morgan, Citigroup, Bank of America, Goldman Sachs. And initially, those names got beat up. The market did not like the earnings numbers. The financials were weak for most of this week's trading. The tech sector, on the other hand, was incredibly strong, and they picked up the slack. They prevented any type of downside pressure from kicking in. There was weak areas. Energy was weak. The financials we just talked about, the financials were weak. We had some of the retailers that were all over the map. But none of that matters as long as the tech names remain as strong as they are. Amazon had a phenomenal week. Apple, super strong. Netflix, Facebook, really, really strong. And as long as those names remain strong, it's going to be difficult for this market to roll back over to the downside. Not to mention, the Fed and the central banks worldwide just continue to pump billions and trillions of dollars at this market. It's just amazing what they're doing to try to prevent any type of damage from being done. As active as they are to prop these markets up, it's hard to ignore the fact that the country is shut down essentially here in the US, right? I mean, there's no economic activity to speak of. And I think it's going to be difficult for this market to continue plowing its way higher when we don't have any type of economic activity. I know there's been talk here just over the past 24 hours from President Trump that they're going to potentially start slowly opening parts of the country again. That's great. That's good news, right? I mean, we all want this virus to go away. So don't get me wrong, it's good news. But I think the unknown there is how quickly are things going to bounce back. The Trump administration keeps talking about how the market is going to and the economy is going to recover very quickly. But this has gone on long enough that damage has been done. And I think it's going to be difficult for the pace of this move to the upside to continue here over the next few weeks. But let's jump into the charts. Let's talk about charts here, because that's really what matters. What I think about the economic numbers and about the earnings, that doesn't matter. What matters is what the market thinks of those numbers. Let me go ahead and zoom in, make my charts a little bit bigger here so you can see them. Let's start out with a daily chart of SPY like we normally do. We do this because we want to place some context around the overall market. Why are we trading the way that we are? I like to start from that top-down approach. I look at the market as a whole before I get into some of the individual stocks on our list. And I do this for a reason. There's so many different option strategies that we can use. We can use long calls, long puts. We can use debit spreads. We can use credit spreads. We can use weekly options and monthly options. There's a lot of ways that we can go here. And I make that decision not based on what I think I can afford. I make the decision based on market conditions. How aggressive or conservative do I want to be given the technical picture of this market? This is just a simple daily chart with a handful of simple and exponential moving averages up top. I've got a volume indicator down at the bottom, and then I've got a 14-period ATR, or the average true range, which is down at the very bottom. So a couple things to point out. Number one, just from pure price action, you can see that it has been a phenomenal rally. The last 3 weeks, it's been phenomenal off of the lows. SPY has moved from 218.26 all the way up to around 285.5 at the highs today. That's a phenomenal recovery. And again, we can go through the reasons why it's recovered. We've had some good news on the virus numbers. We've had the Fed and the Treasury doing everything in their power, to prop the market up. Regardless, price action is king, and price action tells us everything that we need to know. And right now, we are in a massive rally here. However, going into next week, Notice how here at the highs today, we tested, or we're testing right now, the 50-period moving average. It's that yellow mustard colored line right there. Let me get my data box up so we can get the exact value there. So it's the 50-period simple moving average. It's at 285.77, basically right on the high of the session today. If we're going to see markets stall out, if we're going to see some consolidation or a reversal back to the downside, this is a prime area to see that happen. I'm not saying the market's going to completely collapse and fall apart. I talked about it last week. Even in last week's video, we talked about the market being overbought. It's just gotten even more overbought throughout the week this week. What I am looking for going into next week, I would love to see price action reverse back to the downside before the next leg higher. I think the path of least resistance over time is going to be to the upside. I think there's just too much Fed support for this market. But in the near term, I'd like to see a little bit of a reset here. I'd like to see names like Amazon and Apple and Facebook pause, get a well-deserved rest before another push to the upside. Next week, we have earnings that are really going to be kicking into high gear. Over the next 2 weeks, we're going to have a lot of these big tech names, a lot of these big NASDAQ names that have been on phenomenal runs to the upside. They're going to release their quarterly earnings. I think that's going to be interesting because if they disappoint at all, I think there's a lot of room on the downside here for a little bit of an air pocket to burst and get another push lower. On the flip side, if they impress and the numbers are good or not as bad as what everybody thinks, the next wave to the upside, where would I potentially be looking at as an area of resistance? Well, the next period on SPY, the next stretch that I'm looking at is a move up to between 290 and 291. We've got the 89 and the 100 period exponential moving averages up above us. So that's going to be in our next area of resistance. My opinion, even if the earnings numbers are good, I think there's been a lot of good news already priced in at this point. I could certainly see it as more of a, buy the rumor, sell the news type of an event. But obviously time will tell. We'll just have to reevaluate things next week and over the next couple of weeks and see what ends up playing out. So we're at a very key point of resistance on the downside. Our first area of support, we have 280, which is the 50-period exponential moving average. And then we've got the 8-period EMA down at 276.10. That would be the first area that I'd want to see tested. The volume picture, we continue to see volume contract. We talked about this last week as well. The average volume, we went from over 250 to 300 million shares on a daily basis on the wave to the downside to now we're back down in that 125 to 150 million range. It's still a good number compared to what we've had the last few years, but there's no doubt the volume has been declining on this move to the upside. Still a lot of uncertainty out there. There's still a lot of money on the sidelines that has been that's been stuck. People just aren't ready to throw that capital back into the markets as of yet. The ATR, the average true range, you can see that has also been trending lower the last few weeks. We haven't been seen near the wild swings intraday. We're still in a very active market, but it's much more tradable today than what it was even 3 weeks ago. It's becoming easier. Markets are starting to tighten up. They're still pretty wide compared to historical conditions, but we're starting to see things tighten up. It's definitely an easier environment to be active in. That's a good thing. I still want the market to stay active. We just don't need the historic extremes, right? I mean, it was very challenging when you start to see 1,000-point intraday ranges on the Dow. That makes it challenging for traders. The VIX, taking a look at volatility. The VIX is down about $1 today, down below 39. We actually got down to around 37.5 today. So the VIX is well off the highs. On the move to the downside in equities, we saw the VIX get above 80. It has now been cut in half. It's still elevated. Long term, the typical range that we see on the VIX is anywhere in that 11 to 20 range. We're still well above that, meaning there's still a lot of uncertainty out there, a lot of uncertainty as to whether the economy is going to bounce back, whether these earnings numbers are going to be good or bad. And as a result, the market's pricing that in. The reason I point that out is the option prices. When you take a look at some of these individual stocks that we trade, the option prices continue to be very expensive. It doesn't make it a deal breaker. We can still be active, and we are right now. You just have to be cautious on what strategies you use. The long calls, long puts are very expensive right now. You don't have a lot of margin for error there. There's a lot that needs to go right in order to make those strategies work. The credit spreads, on the other hand, in my opinion, continue to be better plays because the volatility is high, because the options are expensive. We can put on a credit spread and better stack the deck in our favor and give ourselves more ways of making money on the trades. We'll talk about that in a moment. We give up the home run profit potential on those trades, but in exchange, we give ourselves a higher probability of success. And I definitely think we're remaining in a window where you're going to want to have some credit spreads on here in the next month or so. All right, so I'm cautiously, going into next week, I'm cautiously, I would say cautiously bullish going out further. But in the near term, going into the next week or two, I would love to see a pullback and test those support levels that we just talked about a few moments ago. Now, let's talk about, let's take that from big picture and let's narrow that down into some individual trading opportunities. Let's start out by talking about the trades from the last few weeks. For those of you that joined us live or you watched the recording, I know I've talked to a number of you that have been able to take part in those trades, and we've had some pretty nice results on those. So glad that some of you were able to take advantage of those. So let's start out by talking through XLE. This is the energy ETF. Well, going back a couple of weeks, we had talked about selling a put spread. And the reason for that, let me jump over to the chart. I'm going to go from a daily chart to now I'm looking at a 195-minute chart. This is the chart that we typically use for our entries, for our targets, stops. More active than the daily chart. We do have our custom indicators on this chart, which we'll come back to in just a moment. But what we did is we looked at XLE at an oversold condition a few weeks ago. We had the energy sector getting beat up. We had an oversold condition, and we knew that because our %R indicator plotted yellow. We had a whole series of yellow bars indicating that we were oversold in the near term. It doesn't mean XLE has to immediately bounce higher, but when you do see those extremes, it typically leads to a period of consolidation or even a reversal in the other direction. Well, that's exactly what's happened. It hasn't been a massive move to the upside, but we have seen a move off of the lows. You can see that we have slowly been trending back to the upside. Well, what we decided to do to take advantage of that move, we came into the May monthly options and we sold the 26-24 put spread. Meaning I was selling the 26 put and buying the 24 put at the same time. It left us with a neutral to bullish position. We made money as XLE moved to the upside. If it stayed above 26, we made money. Well, it's currently sitting at 33.5. So we have stayed above that strike price of the option that we sold. That's exactly what we needed to have happen. So let me go ahead and load that trade up down at the bottom. So we sold the 26 put. We bought the we bought the 24 put. We collected 60 cents or $60 per spread on that trade. The $60 per spread was our maximum profit potential. That was the most we could make on the position. We were risking $140 per spread to put the trade on. So very reasonable on the cost side. Wasn't tying up a ton of capital. Gave us a nice profit potential. Regardless of account size, this was a trade that you can put on and keep your risk at a very low level. Our target zone was 50 to 75% of our max profit. If I collected 60 cents and that 60 cents was my max profit, I wanted to buy it back for between 15 and 30 cents. That would allow me to keep that desired profit. I always start my closing order at that 75% level, which is at 15 cents. It's kind of been bouncing around between 15 and 20 cents here today. All right, so this trade can be closed out. It can be closed out right at that 75% level. So if you've got the trade on, if you don't have a closing order working already, probably want to get that done. Probably want to get that in place. Why wouldn't we hold the expiration? Because we've only got 18 cents of profit potential left on the trade, and we still have 28 days left to expiration. If we hold, we run the risk of letting the trade go from a winner to a loser. And I'm not willing to take that risk. In this market where we have so much activity, things can change in the blink of an eye. I want to book the profit, free up the capital, and move on to the next trade. All right, so nice trade, nice winner there on XLE. The next one is SLV. This is the silver ETF. And we took a different approach on this one here a couple weeks ago, and we just bought the outright calls. We bought the long 13 calls out in May, and we paid around $113 per contract. They're now trading for $1.35. They were almost at $2 here earlier in the week. You can see silver having a rough day today, down about almost 3%. But we're still profitable. We're up around between 15 and 20 cents, depending on where you got filled at. So you're up about 20 bucks on the trade. Nothing significant as of yet. Still have the position on, still looking for another wave to the upside on silver. So nothing we need to do. We can continue to hold that one going into next week. Not a single thing you need to do on that position. So that one's pretty easy. That one's pretty easy to cover. And then the trade from last week is on EA. So let me shrink some of this down here so we can take a look. Actually, let's start out on the chart of EA. So this is Electronic Arts. We came in last week and we were looking at an overbought condition. We knew that because the pulse indicator down at the bottom was firmly yellow, indicating that we're overbought. Doesn't mean EA has to stall out immediately, doesn't have to fall apart. It just means that going forward, it'll typically lead to a period of consolidation or even a reversal to the downside. Now, we haven't had a huge reversal as of yet. We are down about 3% today, which is great. But what we did last week on EA is we sold the 108, 110 call spread out in the May 1st weekly options. So let me go ahead and load that trade up. So we sold the 108 call. We bought the 110 call at the same time. We collected on this trade 72 cents or $72 per spread. That was the most we can make on the trade. That's our maximum profit potential. Unfortunately, the trade has moved against us, and it's now trading for $1.45. So as of now, we're down about $73 per spread. What do? Do we close the position out? Do we take the loss and move on to the next trade? Do we hold? Here's the situation that I'm looking at. The chart pattern, flip back over to the chart. The chart hasn't changed. In fact, we have gone from overbought to even more overbought this week. So I'm still looking for a move to the downside. That my outlook hasn't changed there. On this trade, I need price action back down around 108. I need about a $6 sell-off here. In this market, a $6 move on EA, that can happen very quickly. We're still in a very volatile environment. It's a fully risk-defined trade. Okay, I know what my maximum loss is right up front. So I don't mind holding the trade. If it continues to move to the upside, yeah, that's not going to be ideal, and we'll potentially take it off next week at that point. But at the moment, we're going to continue to hold. The market is still overbought in the near term. We mentioned it a few moments ago. I am expecting another push to the downside here going into next week. I thought it was going to happen this week. It just didn't in most names. So we're going to hold the position, look for a move back down towards 108 going into next week. Okay, so nothing we need to do there on EA for the time being. All right, so now let's go back over to the charts and let's talk about a trade that was potentially setting up for next week. Let's go to QQQ. This is the NASDAQ ETF. Going into the next few weeks, we have earnings, as I've mentioned already. The earnings numbers are going to pick up in a hurry. And a lot of the big tech names are going to have their earnings. It's a little bit higher risk because those earnings numbers can cause some pretty significant movement overnight. I don't mind that because we're still able to structure the trade in a defined risk manner. Okay, and I'll talk about that in just a moment. We're overbought here. And when I say overbought, I've had some feedback from people stating, how are we overbought? I mean, the market just got crushed 3 weeks ago. That's true, it did, but it's also well off of the lows. And when I say that we're overbought, I'm talking in the near term. I'm talking about the next week or two. I'm not talking about the next 2-3 months. We could very well be higher 2-3 months from now. But in the near term, we're overdone. And the NASDAQ has actually been lagging behind the rest of the market here today. Makes sense. It's due for a pause. I consider overbought because the pulse indicator down at the bottom has a whole slew of yellow bars printing. We're overbought because price action has reached between a 1 and a 2 standard deviation move on the upside. When you start to see those types of extremes, it'll typically lead to either a pause or a reversal in the other direction. Look what happened the last time. We had yellow bars. Going back a couple weeks, we had yellow bars on the downside, indicating an oversold condition. What happened? Price action bottomed. And we know what's happened the last few weeks. We have bounced back to the upside. We're now seeing the whole thing flip around. Now we're overbought. Now we're expecting either a period of consolidation or a move to the downside. So let's jump over to the trade page. Switch this from EA to QQQ. We have to decide what expiration cycle we want to go with. I have been trading a lot of the May monthly options here this week. Reason being, they've got 28 days left to expiration. In most cases, I want to trade the options that have between 20 and 40 days left. So that cycle does fall into that range. The monthly options also are going to give you the best liquidity. They're going to have the best volume and open interest numbers. The higher those numbers, the easier it's going to be to get filled on trades quickly and at a good price. So we're going to open up those May monthlies. I'm going to take a look at selling a call spread. We've already established the market is overbought in the near term. We've already talked about volatility being elevated. And when volatility is high, the options are more expensive. I want to sell a credit spread to start stacking some things in my favor, giving myself more ways of making money on the trade, giving up the home run profit potential in exchange for a higher probability of success, in exchange for a more forgiving trade. And I like that given the current environment. So we're going to go to the out of the money calls on the left-hand side. We're going to start out with the 220 calls. I'm starting out there because they have around a 65% chance of closing out of the money. I'm going to right click on those, go to sell and select vertical. Pops up an order down at the bottom where by default, it's a dollar wide spread. We're selling the 220 call and buying the 221. Because there's a dollar difference between those strikes, I want to make sure I can collect between 30 and 40% of the difference between those strikes. I want to collect between 30 and 40 cents. This one allows me to collect 43 cents. That meets my criteria. I could place this trade as is. I'm going to take it one step further. Instead of buying the 221 call, I'm going to click on the drop-down menu and switch that to 222. I'm going to move it on out to a $2 wide spread. That allows me to collect more premium, allows me to push my break-even point a little bit further away. Yes, I'm going to tie up more capital to put this trade on, but I'm able to collect 84 cents. Doesn't matter if it's a $1 wide spread, a $2 wide spread, I'm still looking to collect between 30 and 40% of the width of the strikes. So if I get filled at 84 cents, I would be risking $116 to make 84. Okay, that does meet my criteria. Okay, we're typically in the risk 2 or 3 to make 1. We're actually slightly better than that. The reason why I'm willing to accept that ratio is we have 5 ways of making money on the trade. Let's talk about those 5 ways now. Look at our break-even point in this order confirmation box. It's at 220.84. That number is calculated by taking the short strike at 220, adding in the 84-cent credit that we're collecting to put the trade on, and that gives us our break-even on the upside at 220.84. The current price of QQQ is at 213.30. And we've got about $7.50 on the upside that this thing could move against us and we can still make money. The only move that hurts us is a big move higher. If we move slightly higher, sideways, lower, all 3 scenarios, we're okay. We make money as time decay adds up. Every day that passes, that time decay helps us. We also make money if volatility decreases. So there gives us 5 different routes to follow to make money on this trade. It is a neutral to bearish position. We make money the fastest if QQQ moves to the downside. If it doesn't, if it moves sideways or slightly higher, we're okay. All right. Where's our profit target? If we collect 84 cents here, my target is going to be between 50 and 75% of what we collect to put the trade on. So if I can buy this thing back for between 21 and 42 cents, that would allow me to keep between 50 and 75% of my max profit. All right, so I would set my order, my closing order. Once I put this position on here today, I would place my closing order at 21 cents. That would be the 75% profit number. And that way the order's working. I don't have to sit there and watch it all day, every day. I just check in on it periodically. Really forgiving trade. Really, I hate to say set it and forget it because there's no such thing in the markets, but it's one of those trades that's more hands-off when you compare it to just buying an outright call or put. It's another reason why I love to use the credit spreads. And I continue to get some questions on this. When will we take a look at buying more calls and puts? We'll absolutely do so when market conditions warrant. When we start to see volatility contract a little bit more, when we start to see options a little bit cheaper than what they are now, we'll have no problem switching our focus from the credit spreads back to the long calls, long puts. Having a mix of trade types makes a huge difference long term. All right. So if you have any questions on the QQQ trade that we're talking about doing here this week, you can either do it this afternoon or you can revisit it Monday morning. Should be valid Monday as well. If you have any questions on this trade, feel free to email me, mike@netpicks.com. You can always comment here on Facebook or in YouTube, and we can certainly get back with you there also. And then if you have questions on the trades from the last few weeks, the ones that we recapped here a few moments ago, feel free to contact us there as well. We're more than willing to help out with those trades also. Just a quick reminder, we did have a 2-day options workshop here this week on Wednesday and Thursday. Let me go ahead and get it up on the screen. We recorded both days. It's completely free training. Okay, so all you have to do is go to this link, netpicks.com/options course 1. So I put that link up on the screen. Go to that link. We did record both days. You'll have the videos there to review. I also included all of my slides as well, so you have access to all of that material. It's really a good resource if you're brand new to options or if you're looking for more of a methodical approach to the markets. Take a look. We open up our entire toolbox and we walk you through our 3 favorite option strategies. We outline the exact criteria that we use for each of those strategies. So we'd love to have you take advantage of that training. Feel free to give us some feedback, and we'd love to help you out here going forward. So again, netpicks.com/options course 1, completely free training there. Feel free to take advantage. So I'm going to start to wrap this video up here. I'll be back again next week with our next options market recap. Enjoy your weekend, everybody. Stay safe, stay healthy, and we'll talk to you again next week.